Good morning, everyone. Welcome to the July 26, 2023 Board of Directors meeting, and we'll start with the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
No, in the mornings I'm fast.
Chris,
In the late afternoons, I'm done.
roll call for us?
Division 1,
Here.
Division 2,
Here.
Division 3,
Here.
Division 4,
Here.
Division 5.
Here. Okay, so we will start with public comment on items not on the agenda. Okay, seeing none, we'll move on to special orders with the investment portfolio.
All right, I do not see.
They're here.
They're here?
They're on Zoom. There you go.
Oh, I see Monique. Hi, Monique. All right.
Good morning.
I'm gonna turn it over to Monique.
All right, good morning, Good morning, everyone. I am joined by my colleague, Allison County, who I believe you had the pleasure of hearing from before. Allison is going to lead the vast majority of this morning's discussion on the second calendar quarter performance results. So with that, I believe Allison has some materials to share, and we will get right into the report. Of course, as always, please feel free to ask any questions throughout.
All right, thank you, Monique, and good morning, everybody. I believe you should be able to see my screen now with the presentation, so I will just full screen this, and then I will kick it off. All right, please, as we go along, if you have any questions, jump in. It is tough for me to see everybody, so I don't want to miss any questions as they come up. So as we always do, we'll just start off the presentation with a brief economic update, talking about what happened in the market with interest rates during the quarter ended June 30th. So here on page 1, looking at the current market themes. So in the US economy, we still have high inflation. And you'll see here, if we compare to prior reports, we actually say high or headline inflation, but trending lower. So inflation has been elevated for quite some time, but it has also been trending lower for quite some time. The latest reading of CPI, Consumer Price Index, showed us that headline inflation was just 3% year over year in June. So prices rose 3% from June of last year. Headline inflation means that it does not exclude anything, and particularly it does not exclude food and energy. The other type of inflation we talk about is core inflation, and that excludes food and energy. We also mention here, maybe for the first time, super core inflation, and that's where we remove the prices for food, energy, and housing. And when we look at super core inflation, we can see that it has not been moving down as steadily as that headline inflation. And we'll talk about that more on the next page. So looking at the US economy again as a whole, the labor market continues to be quite strong. Looking at the last quarter, we did see the number of jobs added each month slow down a little bit from the pace we saw over the past year. But that said, the unemployment rate is at 3.6%, so very low. And we do see the labor force participation rate tick up a little bit. This past quarter, we also saw improvement in consumer sentiment. Through various surveys, we do see that consumers are feeling better about the economy. They certainly continue to spend, which helps drive growth in the economy. And much of that positive outlook is the fact that inflation is coming down. Now turning to the Federal Reserve. So we do always give you an update on what the Fed has been doing since we saw you last. Since March of 2022, the Fed has been tightening their monetary policy in an effort to bring down inflation. The biggest way they have been doing that is by raising their Fed funds target rate, which again, they started doing that back in March of 2022. At their latest meeting in June, the Fed actually did not raise interest rates for the first time of the past 10 meetings. So after hiking rates 5%, so 500 basis points for the past 10 meetings, the Fed did take a pause in June. That said, the Fed has all but told us that doesn't mean they are done with rate hikes. The dot plot, which we'll also look at a little bit later, which shows what the Fed thinks for interest rates, show that the Fed expects 2 additional rate hikes here in 2023. The Fed is actually concluding their July meeting today. I didn't actually get a chance to look. It may have concluded already, and Monique, please jump in if you know, but it is expected that the Fed will hike rates today by another 25 basis points. And that is to bring down inflation, and that core inflation that they do find to be a bit sticky and still has a ways to go before it's at their 2% target. And then turning to the bond markets where we invest the district's funds, we did still see some volatility this quarter. If you recall, during the first calendar quarter in March is where we had the failure of several banks and kind of a general banking or loss of confidence in the financial sector, which drove rates lower. To start the second calendar quarter, if you'll recall, we were dealing with the debt ceiling. The US had reached the debt ceiling, it needed to be raised. We didn't get to the last second, but we definitely, were getting down there. And so that drove volatility in the bond markets. The debt ceiling was raised, so there was no default. And then overall, though, we saw rates move higher during the quarter, led by the 2-year Treasury. Yes.
We just have a quick question before we get too far past.
Yeah, okay.
So there's, as I understand, there's 1.6 jobs per applicant right now. 1.6 jobs available. But so the 3.6% unemployment rate, there's a misery index also that puts the people who are unemployed and those who are not looking, who have given up, at over 24%. How do we factor that in, or can we?
Yeah, the employment sector, there's a lot of different ways to look at how it's doing. Even those ways that we generally talk about, the number of jobs added and the unemployment rate, certainly don't tell the whole picture, and they don't always even, kind of concur with each other, the way they take the different measures. So as you note, when we look at different measures of the unemployment rate, including those who stopped looking for work, because that number I mentioned, 3.6%, does not include those people who gave up looking for work. So there certainly are some weaknesses in the employment sector. And, one of the big questions, I think, when you think about people who gave up looking for work, some of that's kind of, the reasons that we don't know is why they stopped looking for work. Lately we've seen, especially following the pandemic, childcare is still a challenge for many. Also, caring for elderly parents is keeping people out of the labor force. So there are a lot of different reasons that could cause people who would like to be working to not be able to work. So even though there's jobs out there, it doesn't mean that the jobs that are available are suitable to every person. And so to your point, if we were to look at all those who would want a job if they could find the ideal conditions, there's likely, like you said, a lot more people out there who aren't working to their full potential.
And I would just like to add some context. I think, we're still in a situation where the rhetoric on the economy does not necessarily match the underlying numbers. So overall, the misery index, has been coming down with unemployment coming down, with inflation coming down. It hasn't been as high as it's been in the past. However, the news around the economy, what's sort of being talked about in the media, aren't we going to see a recession? Aren't these interest rates too high? Aren't businesses going to see some pain from this? And the reality is that the numbers have not been supporting that. Unemployment has been falling, inflation has been falling. Despite the higher interest rates, housing prices have held steadily on. So, I think there's just a disconnect between what's being reported and what the economy is actually seeing throughout this period.
We have in our division or our district, we have a lot of people who are on fixed income. And during inflationary times, those people are hit hardest because they have no way to protect themselves against inflation. And I noticed that the Fed has put out they're going to keep things tightened until about the end of 2025. So we have maybe 2.5 more years of this. That shouldn't affect our investments too much, but from our standpoint, our customers are affected financially. Inflation going up, and we have to take that into account. Any enlightenment there? Or?
Yeah, I mean, what I will say to that is the trickery in the inflation index is that inflation simply talks about the rate of price change. So, while inflation was going up, what we saw was that prices were increasing faster. Now, just because inflation is coming down doesn't mean that prices themselves are coming down. It just means they're not rising as fast as they were in the last year. So, those folks on fixed incomes are still going to see the pressure of that increased price that occurred over the last few years. Hopefully, we'll just see pricing stay fairly steady, and that's what the Fed is anticipating. Now, because interest rates are expected to be at their highs for the next few years, I think we're projecting perhaps mid-2024 before we see any interest rate declines. That means that the cost of borrowing is still going to be elevated for most. Think, home equity lines of credit, auto loans, business lending, etc. And the Fed is hoping that puts pressure on the economy to keep inflation in check.
Thank you.
All right, I'll go ahead and turn to the next page here. Just taking a closer look at inflation. So on the prior page, I mentioned CPI was 3%, so 3% increase in prices year over year for June. Here we're looking at personal consumption expenditure, or PCE. It's another measure of inflation. It also has a basket of goods, but the basket's slightly different, the calculation slightly different. So the readings are different than CPI, but you do typically see the same trends. And we're showing PCE because this is the Fed's preferred measure of inflation. And when they talk about their 2% target for long-term inflation, which you can see with that dotted line, this is what they want to get to 2%, and specifically that yellow line, core PCE. And so like we talked about on the prior page, if we look at that dark blue line, which is that headline number, inflation has been steadily moving lower since June of last year. And as Monique said, it doesn't mean that prices are coming down. It just means that prices are not increasing as fast. And so again, the Fed does think it's appropriate for prices to increase year over year, but at an overall 2% level. So while that headline PCE, that dark blue line, is coming down steadily, those other measures of inflation, core and super core, which again take out food and energy, and then super core takes out food, energy, and housing, have been much stickier and really haven't been coming down like the Fed would like to see. And so that's why if you hear the Fed talk, when we talk a little bit later about the Fed later today, when the Fed meeting statement comes out, we'll see that they do continue to think it's appropriate to tighten monetary policy, keep those interest rates elevated to bring down this core inflation. Talking a little bit more about the Fed and what they expect to see. So the Fed releases economic projections 4 times a year. These latest ones were from the Fed's June meeting. And so on this page here, we're showing some of those projections, and we're looking at what the Fed said in March in the lighter bars versus what they said in June in the darker bars. And really the biggest change was in that upper left-hand corner, looking at GDP in the US. And you can see in March, they expected pretty minimal growth here in the US, but that was revised higher. Now, 1% GDP is still quite low. Pre-pandemic, growth was averaging around 2.5%. And so the Fed does still expect there to be some slowdown. As Monique said, right now, really the probability of an upcoming recession has really declined recently, but we still do expect, relatively slow growth over the next couple of years as this tight monetary policy, these high interest rates are expected to remain high for that time period. The other projections we see here are the unemployment rate, the Fed showing that at around 4.1% by the end of the year. They would like to see the labor market tighten up a little bit, not have so many outstanding jobs for people looking when the labor market is this tight, you tendency to have wages continue rising. And so the Fed doesn't want to see wages continuing to move higher at an elevated pace as prices are coming down or as inflation is coming down. The Fed's inflation projections are in the lower left-hand corner in yellow. So they're projecting that core inflation, which we showed earlier at 4.8% currently, will come down to 3.2% by the end of the year. So a good drop there, but still pretty elevated compared to their 2% target. And if we look at this projection, they think it will be several years before they get inflation back down to 2%. And then finally, on the right-hand side, the Fed funds target rate. And for this, I'll just turn to the next page. With the Fed's projections, they also give us this, what we call the dot plot. And this shows where members of the Fed think that Fed funds target rate should be at calendar year end. For each year, each member of the Fed, votes, if you will, on where they think the rate should be, and that's what each of those dots represent. So for each year, each person says where they think the rate should be. Right now, prior to the Fed going into today's meeting, that rate is right here where these two bottom dots are at a range of 5% to 5.25%. So if we're reading this, that means two members think that the rate should not move any higher during the course of the year. But if we look at that average where the line is cutting through, this implies two more rate hikes. So a majority of the members think the Fed will need to raise their target rate 2 more times in 2023, bringing that rate up to just over 5.5%. What this also tells us for 2023 is the Fed is not expecting any rate cuts in 2023. However, by the end of 2024, a majority think that the Fed will have cut rates a few times. The Fed would like to get rates lower again. They think the ideal place for their target rate is right around 2.5%. And so over the course of the next couple of years, given the data they have now, all this could change, of course, if there were any type of large negative economic event, if inflation does not continue to move lower, this could all change. But for right now, the Fed is thinking, that rates will remain elevated for the next couple of years before getting down to their 2% kind of target there after 2025. Turning to the next page.
Chris has a question first.
Go ahead.
Huh? Well, how do they factor in? A lot of credit card balances are going up, and people have to pay over 20% on that. How do they factor that inflationary in here, or do they factor that into the index?
Yeah, so, they make these projections or kind of each individual decides what they think and for their projections based on, current economic conditions. But of course, they do factor in things you mentioned, like we're seeing credit card balances at their highest levels in some times. At the same time, saving rates are down quite a bit. We also know that many people, for the past year or so, their spending has really been propped up by stimulus that we all received. So that is a factor, there's something that the Fed thinks about when making these projections. But based on, what the Fed is showing through these, they do continue to think, the economy will continue to grow, that these instances you're talking about, while will have negative impacts, for sure, for certain individuals and through various pockets, that overall the U.S. economy should stay relatively strong.
Yeah, and I just want to add some additional color context to that. In some ways, that's the point of the Fed's action. The point is to cause a little bit of angst, a little bit of pain in the economy. As the Fed raises rates, interest rates on credit cards go up. Again, interest rates on HELOCs go up and car loans go up. The point is to cause that pressure and that angst so that folks slow down on their economic activity. Now, rational consumers aside, the theory underlying that is that if folks see higher borrowing costs, that they will, slow down on their spending. Now, we all, as people who spend money, know that's not necessarily always the case, but that is the underlying economic theory at work here, that increasing those borrowing costs, increasing lending costs for consumers is going to help slow down the economy, which is the point of the Fed's activity at this point.
Great point. And so that segues into a question. How do they know their suppression of the economy through interest rates is affecting inflation, or is it the supply side, more things are being made? So the price of items come down because there's more supply and demand. Is that number ever given out, a percentage?
I have to look deeper into sort of what the releases are. But, all of those things sort of work together. There are a number of different programs that are at play here, some in the federal government, some at the Federal Reserve, to overall impact inflation. And a lot of the initial inflationary price pressures was because of the supply chain issues that we have, to some extent, which are resolved in a lot of quarters of the economy. But, those things together caused a lot of pressure and caused inflation to rise at a significant rate. And the Fed felt they had to take severe action, which is why they've raised rates so fast over the past couple of months.
Allison, my question is, what's the explanation for 2025, the Fed being all spread out like that?
Yeah, when you see these, the further you go out, the murkier the crystal ball becomes. This is typically what you see when you look at these projections. The further out, the more varying the projections are. These are individual economists. For 2023, the data is relatively solid, but of course, as you get out, it's probably a member of the Fed who thinks potentially that inflation will not come down, and so will not come down as quickly. So while I can't say what they're thinking, that is very common to see the further you go out, more dispersion in the projections.
But then they come back together in the longer run.
Yeah, I think part of that is a decision that they think the longer run, and again, I don't know if it's ever been specifically defined longer run, but most of them agree or feel that target rate, the ideal place for it would be 2.5%. So it's kind of more that eventually it will get to where they want it to be, which is 2.5%.
Perfect. Thank you.
So I'll move back here to the interest rate slide. So with the U.S. Treasury yield curve on the top half of the chart, we're showing how interest rates moved over the course of the quarter. The dotted line, the start of the quarter, the solid line, the end. For the district portfolio, we invest in that 5-year and under area of the curve, but we're showing the entire curve here. But so you can see going from the dotted line to the blue line, rates did move higher across the yield curve. And the bottom chart shows you the change in interest rates. And so we can see with that chart that rates moved up the highest in that 1 and 2 year area of the yield curve. We did kind of like to see this rate movement during the quarter. During the first quarter of the year when rates fell after the banking issues, we were under the impression they were a bit low relative to what the Fed was telling us they were going to be doing. And so we kind of saw that rates corrected themselves a bit during the quarter. And as we'll talk about in a few pages, it had an impact on the portfolio activity and what we were buying for the district during the quarter. And then lastly here, looking at total returns for the markets. So not yet talking about the district's portfolio, I'm just showing how the fixed income markets did during the quarter on a total return basis. So again, that factors in unrealized gains or losses due to changes in market value, as well as realized gains or losses or interest earnings. So if we look at the left-hand side, which are the returns for the quarter, you can see that treasuries and agencies had negative returns for the quarter, meaning their unrealized market value losses were greater than their realized earnings. The credit sectors did manage to return positive numbers. The asset-backed securities sector, you can see there, did quite well. That has to do somewhat with its duration being a bit shorter than the others, but also high-quality corporates did relatively well and managed to return a positive performance. We do like to keep the longer-term look in perspective. So if we look at the right-hand chart, the past 10-year average of these sectors, you can see not only are they all positive, but historically, you know, those credit sectors perform better than the government sectors. And this, as we'll talk about in a bit, is really why we think diversification of a portfolio is very important. So I'll turn now to the portfolio. So here, looking at the consolidated summary, just as a reminder, the portfolio under PFM system is split into two portfolios. A majority of the funds, almost all of them, in a managed portfolio, but the district does hold several bank CDs that we don't, manage because they'll just sit till maturity, but we do provide some reporting on them. So with those funds combined, there's about $90 million that the district has invested. And then here you can see what the issuers are of those funds. So again, those CDs here in orange make up just 1% of the funds, with the remainder in that managed portfolio. And we'll talk about that in more detail on this page here. So here we're looking at the portfolio snapshot. So this just excludes those CDs. So the funds that PFM is actively managing, about $89 million in total market value. So the sector allocation on the right-hand side, the portfolio is comprised about 87% of federal agencies. A majority of those are callable federal agencies that likely won't get called given interest rates have moved up so much since those securities were purchased. We'll talk about a little bit later. We did add U.S. Treasuries to the portfolio for the first time since we took over management. Essentially, the strategy since we started managing the portfolio has been to allow securities to mature, and those securities have been commercial paper. And then we've been reinvesting those maturities back into commercial paper. Those very short-term rates, as we saw a few pages ago, have very attractive yields. But we are also doing that strategy because the overall maturity distribution, average maturity of the portfolio was quite long. Again, given that all those federal agencies will likely go to maturity and will not be called. So we were reinvesting very short, again, taking advantage of short-term rates and shortening the overall maturity of the portfolio. This most recent quarter, because of the rate movement I talked about, we did finally add some longer term securities, and I'll talk about that in a couple pages here. I will say the duration distribution chart is a bit misleading. If we were to look at this by maturity, we would see that the average maturity on the portfolio is about 2.4 years, with just 5% maturing in the next year. So when we look at the maturity distribution, the portfolio is much longer than what it appears to be on this chart. Then the portfolio is very high credit quality. The federal agencies and U.S. Treasuries are all rated AA+ by S&P. And so that's the bulk of the portfolio. And then your credit instruments are very, very highly rated, A- or A1 for the commercial paper. Again, here are the issuers in the portfolio. A majority of them are the federal agencies, divided between 3 federal agency issuers. What we will see as we move forward, as we buy additional credit instruments for the portfolio, is you will continue to see additional diversification, not only among sectors, but also issuers. You can see here that the issuer allocation to the credit instruments are quite small, and those will be kept quite small as we go along, just to increase the overall safety of the portfolio. Now here's the portfolio activity for the quarter. So there were about $5 million of commercial paper matured during the quarter, and almost all of those funds were reinvested in 4.5 to 5 year securities. I mentioned these are the first longer term purchases that we have made for the portfolio. We had just been purchasing commercial paper. Again, we thought now was a good time to lock in interest rates. Interest rates are near their highest levels in 15 years. The securities that we did buy for the portfolio had yields right around 4%. And so a 4% yield on a security with a 4 to 5 year maturity will continue, that will provide the district good earnings for the next 4 or 5 years. So we were very happy to be able to lock in those securities with those interest rates during the quarter. Now turning to the, yes.
Good question. So if the Fed's going to bump up another 25 points, another 25 points, so you're starting to see the long term come down. I saw that graph where the long-term yields are starting to come down already.
Yeah, so over the past quarter, rates actually moved up a little bit. They did move a little bit higher over the quarter, but I will say we're starting to see them more stabilize. They've kind of been continuing to trend higher, but they're starting to stabilize, and that will become even more so, as the Fed really does pause their rate hikes or stops their rate hikes. So while it's possible that rates are not at their very peak of this interest rate cycle, they could trend up a little bit higher, because you can't really time exactly when that will be. Interest rates we thought offered those longer term, 4 to 5 year, offered really good relative value, compared to where they were last quarter, and certainly compared to where they were a few years ago. So while possibly not at their peak, we do think they're nearing their peak and offered very good value.
Yeah, you never can hit the peak, but it's better to get in now a little bit, and then just average cost it over a little while, and then we'll come out better.
Yeah, exactly. And the portfolio does continue to have more maturities over the course of the next year. And as we saw on that dot plot, while rates may move down some over the next couple of years, they'll still be quite elevated. In the 4% range next year, maybe 3% the year after. So while they're moving lower, they are expected to stay elevated, which will be really great for the portfolio. Not just a district's portfolio, anyone who bought a security 2 years ago or are holding securities that are earning 1%, so much lower than market rates. So the maturities coming due, the current interest rate environment will be a good opportunity to add these higher yielding securities to the portfolio. This page here, we look at the return on the district's portfolio as well as the benchmark. We are showing each of the past quarters. Next year, we can put that into next quarter, we can put that into a 1 year number. But just looking at the second quarter here, so 2Q, you can see the portfolio, positive interest, but the change in market value was negative. So those rising interest rates led to unrealized market value losses for a total dollar return that was slightly negative, equating to a return of minus 0.55%. But you can see that versus the benchmark, which is in the footnote, the 1 to 5 year US Treasury Index, the portfolio did very well versus the benchmark during the quarter. And so that we do like to see that outperformance of the benchmark. And then lastly, we show you the earnings on the portfolio without looking at those unrealized.
Sorry, Allison, I think there's a question. Was there a question there?
Yeah, Allison, on the last slide, if you were to overlay S&P 500 over this chart, it'd be like 16%, right?
Yeah, the S&P, I'm not sure what, it had a pretty good quarter, this most recent quarter. I'm not sure what it was. But yeah, so the equity returns, of course, we don't compare it to that, given that we are investing in the bond markets as required by California government code. But yeah, I'm not exactly sure what the S&P returned for the quarter. I believe it was a pretty strong positive return.
It's like 18% year to date or something like that.
That was almost 12.
Yeah, we're just restricted by the code.
Yeah, unfortunate.
Yeah.
No, I think stock market, we could lose it big time.
Right.
You could lose again. Yeah. There are some states, I think Florida is one of those states that allows public agencies to invest in, I think, whatever they want. But some of those localities in Florida lost big time because I think there was some cryptocurrency exposure and other things that you don't necessarily want in your public funds portfolio.
Okay, thank you.
Yeah, so California does restrict you, but the district's investment policy is broad as far as California government code allows, and so you are able to take advantage of much of what they permit, which does not include equities. And then just lastly, again, the realized earnings on the portfolio over the past 3 quarters, which includes your interest earned. If we were to sell a security prior to maturity, which we have not since we took over management, that would come with a realized gain or loss, and then your change in amortized costs. So you can see that over the past 3 quarters, compared to the last quarter, your interest earnings have continued to slowly trend higher, and we would expect that to continue as we add higher yielding securities to the portfolio. So that's the last page I will cover. The remainder of the report just gives you all the details on all of the holdings in the portfolio. We also do include a snapshot of the other investments, those CDs, which you can see here. So those information on those securities are also in the report.
Thank you guys for doing such a great job, because you inherited a mess.
Well, it's been difficult to navigate the last year or two.
And that too, yeah.
Thank you.
Thank you.
Thank you.
Public comment?
You can, it's up to you.
All right, any public comment on the investment portfolio review? All right, seeing none, we will move on to the consent agenda.
I move to approve this.
Public comment on the consent agenda? Okay, seeing none, we'll take a vote.
Division 1,
Yes.
Division 2,
Yes.
Division 4,
Yes.
Division 5,
Yes.
Division 3.
Aye. Okay, and now we're moving on to general orders and the annual comprehensive.
All right, well, I will kick it off, and then Susan needs to be.
Promoting your panel.
There we go. All right, so I'll just start off with a little bit of background. The annual financial audit is required every year annually, and it is based off of our fiscal year. What is not required is the preparation of the full documents of the entire annual comprehensive financial report, now called the ACFR, as opposed to the previous designation for it. So the proposed, or the audit that is being presented is for the time period of the 2022 calendar year, so January 1 to December 31st. And the annual financial audit is basically provides the annual financial statements for the district, And we do hire a consultant to assist us with the preparation and completion of the audit. And they are referred to as MUN, as I'm gonna butcher it, Susan. You wanna help me?
Manurudia Nelson CPAs.
And they've been this is the second year, I believe, that you've completed the audit for the district. So this was a decision that the board made, third year or second year?
Second year, second.
This is the decision the board made to switch auditors, which is always a good idea to get a new set of eyes on your financials. So they basically come in and audit the sufficiency of our policies, procedures, and from an accounting perspective, and ensure that we're following all of the acceptable accounting practices. And I do want to, Susan's going to provide a presentation, but overall the audit did great, and that was a huge testament to the accounting and finance team. They have just gone leaps and bounds in shoring up their processes, and under Sandra's leadership, this is an audit that we're very proud of. There is one finding, it is associated with previous cleanup that was completed that Susan can discuss a little bit more. And then the only other item, well, two things. One item is that there was some significant changes in the OPEB and unfunded liability, which are both pension retiree related. So if you'll recall, OPEB is other post-employee benefits, which is associated with retiree healthcare obligations, and unfunded liability is associated with our pension obligations. Those are valued every 2 years by an actuary, both by ourselves, that actuary that we hire, and then through CalPERS valuation report as well. The reason why I call that out is there was a pretty significant increase in the OPEB liability. And what we're going to do, and there's a lot of reasons for it. One, market related. Number two is primarily related to in past years not having the correct number of staffing included in the valuation study. So what I've asked is our third-party actuary that completes the report, they are in the process of doing an updated study right now, and they're going to come probably in the September, October timeframe and do a full overview of the valuation so that you have an opportunity to ask the expert the questions, because the calculations can be fairly complex fairly quickly. And then the second item I wanted to point out before I turn it over to Susan was Karen brought to my attention, and it was very strange, on page 65 of the audit, part of all the tables in the back of the audit document, it's referred to as the statistical section. And often what happens is it's a giant multi-tab spreadsheet that essentially gets updated by staff every year, and it's sent to the auditors for inclusion in the document. As President Hull pointed out, the table on page 65 related to top water customers was incorrect in its statement of the percentage of overall total sales for both raw and treated water. I did pass out a revised table, so we'll get that included into the final report. And with that, unless there's any questions before we kick Susan off.
I just have a comment. So I'm, Director Beerwagen and I have been here through, I don't know, 4 of these now, 4 or 5. Yeah. And so I went back and looked at my notes. First of all, this is the CAFR, so it's called CAFR.
Oh, back
then it was called CAFR. And you can see all these little flip pages, and those are all the
comments.
And what I will share is that in 2020, there was 150 entries for corrections. Okay. There was, oh gosh, it was just sort of unbelievable. And 59 adjustments to the closing entries that were required by this audit firm. And there was another 25 findings, and many of these findings had been on our audit since 2017, so they've been on for years. And I just could not be more thrilled with the results of this audit. And thank you, Jennifer, Thank you, Sandra. Thank you, everybody who had something to do with this,
Yeah.
Susan. Yeah, all of you who put this together and unwound the mess that was here. It was a huge undertaking, and I just really appreciate it. When I went back and looked at the last several CAFRs, it was shocking.
Yeah, the accounting team deserves all of the credit. They have just gone leaps and bounds on improving processes. And the number one thing that they're doing that is extremely beneficial, that has addressed the majority of the issues, is they're starting to reconcile on a regular basis. So they're not having to do this big recreation of what happened over the year at the end of fiscal year.
Yeah, she shared that with us in one of the last meetings.
Yeah.
Wow, what a concept.
And the good thing is the district's financials are relatively simple in comparison to more complex agencies. And so we're feeling really good. You know, it's doing great. And Sandra is just a breath of fresh air to the district, and the accounting team, they are just blossoming. We have Desiree, she's one of our accountants. She's doing wonderful. Diane is new to our team. She's currently a finance assistant. She's doing great. Elizabeth in payroll. Valerie, she is also an accountant there. They're doing just a wonderful job, and even accounts payable with Jennifer Merced, they're awesome, so couldn't be prouder of them.
Yeah, Rigby, thanks for pointing that out.
Yeah, well, I just wanted to take a look back over our shoulder to see how far we've come, and really appreciate the work of staff and your leadership, and thank you.
All right, Susan, you want to take it away with the presentation?
Okay, I will share my screen. Oops. Can you see my screen? No, let me see, go to this one. This one. Oops. Let's see, where's my presentation? There we go. All right. So you'll notice that it says Justin Williams. He's the partner on the audit engagement, but he wasn't able to be here today. So I am stepping in his place. So just a little bit about the audit process. So we've audited the financial statements of the district for the year ended December 31, 2022. And the financial statements are the responsibility of management. They're not our responsibility, they're yours. And our responsibility is to form an opinion on those financial statements. The process of the audit, it started in, well, starts before then, but with our planning, but our interim audit field work occurred in April. And we do some planning. This includes some analytical review. We review board minutes, inquiries of the client. We assess risk. And then we document through all these inquiries and testing. We test your controls and we document what your controls are that are in place. And then we test to see if those are operating properly or as designed, really. So we've tested cash receipts and revenue, cash disbursements, expenses, payroll, and financial reporting. Financial reporting includes like journal entries, bank reconciliations, you know, that kind of thing. And then we also review the prior year findings. The findings we had from the prior year, we go through those, review those to see if they've been implemented or if they're going to be a carryover. Our year-end field work occurred in May. So it was just about a month after the interim field work. And so our year-end field work, what we're testing there is we're looking at the year-end balances, activity through the year. So we do a lot of cutoff testing. We confirm balances, such as like a lot of the bank balances. We confirm those with your banks, financial institutions. Any debt balances, we confirm those. And then we do a lot of analytical review procedures. Year-over-year analysis on things like your revenues, expenditures, and then we also look at budget versus actual. And then we ask questions, and then we do detailed transaction testing. And then after all of those things are done, then we go into financial statement preparation mode. And now, obviously, reporting the results of the audit. So reporting the results of the audit consists of, we've got our independent auditor's opinion. There's also a government auditing standards report, which is, we tend to call it the internal control report. An audit conclusion letter. So that's the one you'll see, we call it conclusion communication. So that's our communication to you, the board, about various things. And then we have our management letter. And so management letter can include lesser findings, more control deficiencies, or things that you want to put into place to help improve your controls and things like that. So our independent auditors report, our opinion, there's 4 different opinions. You can have unmodified, a qualified opinion, an adverse, or a disclaimer of opinion. So a disclaimer would be, we're not even giving an opinion. In your case, you have an unmodified opinion, which is the best opinion. It's considered a clean audit opinion. So that's always really good. And that's a good, as Jennifer said, a good testament to staff for doing a really good job. So the government auditing standards report, that's one where we talk about if there's material weaknesses, significant deficiencies, that kind of thing. There were no material weaknesses. There was one significant deficiency, and as Jennifer said previously, that had to do with a prior period adjustment to capital assets. So in a prior year, the district had done some capital assets cleanup. And when they were doing the cleanup, they had inadvertently written off some assets that they still own, that you still have. And so that was discovered during this 22 year. And so those assets were put back on the books. And so that's what why it resulted in a prior period adjustment, because those should have been there before and they were incorrectly taken off. So there was the one significant deficiency. And then there were no compliance exceptions noted, which is good. Our communication with those charged with governance letter, that's the conclusion communication. What we talk about in there or communicate to you is some of our accounting, not our accounting policies, but your accounting policies, some of your significant policies and estimates. There were no new accounting policies adopted this year that impacted the financial statements. So there were, GASB 87 was implemented by the district, but it didn't have an impact on the financial statements. Some of your bigger estimates, your depreciation, that's always an estimate. And then, as Jennifer said, the net pension liability and net OPEB liability, those are big estimates because they're both based on actuarial valuations. We didn't have any difficulties in performing the audit or any disagreements with management. There was one reclassification audit adjustment that we made. There was no effect on net assets. Generally, reclassification adjustment is usually more for financial statement presentation. If something needs to be presented in a certain way, we'll do a reclassifying adjustment. And then there was the one prior period adjustment for the capital assets, and then an audit adjustment for the pension liability to correctly state that amount. Management letter. So our management letter, there were 5 recommendations. One on cash receipt controls and processes, and I know that's something the district's been working on, is tightening up some of those controls, and some of that has to do with the recreation facilities and things. So I know that's something the district has talked about that they're working on. A general update of your overall policies and procedures, especially financial policies and procedures. Some of those are outdated and don't really agree with what's actually being done, the work that's actually being performed. So get those updated. The financial reporting controls that should be taken care of this year. As Jennifer said, they're doing the reconciliations on a more timely basis, and the review and approval of those is happening more timely. So we expect next audit that hopefully some of those will go away. And then cash disbursements, it's really on the credit card side. So there were some people that were approving their own credit card bills. So it's always better to have somebody above them looking at and approving those things. It's not a good control if you're just approving your own, because you can do bad things. And that's what controls are there to help avoid. And then there's an account got refundable deposits. I'm sorry, is there a question?
The folks approving their own credit cards are management positions or staff positions?
It's
Yeah, I
all-
believe there were more.
So essentially, yeah.
Go ahead, Jennifer.
Oh, I was just gonna say, before, there wasn't a real good credit card use policy, and so essentially, if I used my district credit card, I would be the one who would, well, I don't do it, Chris does it for me, but theoretically, I would be the one to code my credit card receipt and then sign off, and then it goes to AP, and then AP confirms everything, and then they pay the credit card bill. What we,
AP.
accounts payable. They're the ones who pay the vendors. So now, and which is normal, so now everybody's credit cards are double signed. So you as the user signs it, and then typically your supervisor. So for like me, Greg signs mine, I say, everyone signs someone's. Like any of you, I would sign off on your expenditures. It's all crisscross.
Oversight.
Yeah. It's just, we've been strengthening, one of our big focuses has been strengthening internal controls, because people who are buying things, opening purchase orders, approving payment should also, those should all be the same person. And so that's been a lot of our big changes, is shoring all of that up.
No hot tubs.
Now, some people don't care for it because it does create more process, but I always tell them it's for your own benefit.
And safety.
I can't approve my own credit card, nobody else should.
No, I don't want to.
Yeah, exactly, that's actually, they should not want to.
Yeah.
Okay, that's surprising, but I'm glad it's been resolved.
Been changed.
Yeah.
There's been a lot of changes.
And
Hey,
then
go
the
on, Susan.
Okay, and then the last item, there's an account, and it includes both refundable deposits and unapplied credits. And so the recommendation there is to split that into two separate accounts, because they are two separate items. And so commingling them in one account, it makes it harder for the district to know what items are which, right? It's all commingled to one. And so it makes it harder to reconcile and know what's happening there. So we recommend that those would be split out into two separate accounts. So in conclusion, you had an unmodified opinion, so that's good. No material weaknesses, also really good. No compliance exceptions. You had one significant deficiency, 5 management letter comments, and 3 audit adjustments. So really good.
Wow.
Yeah.
And that's it. So any questions or anything?
Let's go dance.
I know, really, let's have a party.
That's what to do.
Yeah.
There is never not going to be room for improvement. You'll always see some recommendations in the management letter. And the good news is all of the ones Susan identified, I don't know that there was one we hadn't identified ourselves, and it's just a constant cleanup, improving, cleaning up, shoring things up. It's either making things more efficient or having stronger internal controls. And, I just try to brainwash the staff. It's good you want these controls. So if something ever goes wrong, we can point back to, well, we have all these controls in place, because, fraud does occur. As a board member, I do recommend at some point you watch the movie, it's called All the Queen's Horses. It'll terrify you. It terrified me early in my career, and that's why I'm such a stickler on these issues.
Just have a workshop.
And watch it, we could. It is terrifying. You'll be like,
Yeah.
I have has, Susan, nothing to do with the audit. Great job, thank you.
Oh.
We're directed toward, because on page 65, we have treated water customers, and we have raw water customers. Can we put an associated amount of water with like Lake Wildwood gets 200 miners inches, that's 1,800 acre feet. Is there a way to tell us how much people are buying for that much money?
We have that.
Yeah, I'd look at Dustin on this one, because we're publicly displaying how much water people use, and that's generally a no-no.
Yeah.
We're concerned about this table. I did correct it because Karen brought it to my attention, but we do want to do some looking into whether legally we should even be publishing this, because although it's been done historically, doesn't mean that it's the right thing to do. Typically, you don't share utility data. So,
Can we get internal memos on it if confidentially?
To what end?
yeah.
Well, out of district sales, if we're looking at a 218 process, and how much are they buying, how much are they paying, and, you know, can we bump it up, or do we need to, how do we look at it?
You can't just arbitrarily bump up rates. You have to follow Prop 218.
And that's why I want to know how much they're actually buying and what our actual costs are, because I think our costs are a lot higher.
Well, that'll come out in the Prop 218 process without having to focus on specific customers.
Now, I will also state that this is only a ranking based on sales, not on water usage.
Right.
So although they may be number one rank on how much it costs to buy the water they bought, they may not be the biggest volume.
Remember, out-of-district customers pay a surcharge.
Yeah.
I would just recommend we don't focus. Yeah, I don't see the benefit of having this.
But I'm just, you know.
Well, it was relevant when it showed that 95% of the revenue came from 10 customers.
Yeah, that's relevant.
This corrected things a lot more.
I think,
Yeah, we don't know where, it's one of the statistics spreadsheet is, you know, I don't even know, Susan, probably 20 tabs or more.
It's a lot.
And, yeah, it's a lot. It's one of those items that's just updated year over year, and most people don't go back and look at it. So thank you for taking a look at the data. So it made us look at it, but then it also made us start questioning why it's included. So we'll have this conversation offline with Dustin and report back.
I have a comment, and again, awesome job.
Oh, thank
Way
you.
to go. I can't be more thrilled, because I was the person who went through those CAFRs, like, with a magnifying glass in the last 3 years. So I'm really glad that I didn't have to do that. But this is not totally related to the audit, but I noticed on page 64, there is this water sales and production by type table, and this was part of our discussion last night on water. It's like, well, how much is going into raw water deliveries, and how much is treated, and, you know, what is the revenue and all of that. And I know that, anyway, this was a very nice slide here, or not slide, but table that showed us, it answered all those questions. So I'm wondering if this can go, this information gets moved into the plan for water.
We'll take a look at it, and I for some reason, I pulled the table out of my binder, so I don't know what you're talking about. Yeah, we'll go through and have Chip do some further verification, and then we'll provide something similar.
Yeah, I just think it's helpful, because, I mean, there were questions from the public and us about, well, how much, is our raw water, how much is being used and so on. Now, we don't have the answer to the customer, which we're not going to do, but
Right.
It's just interesting. I don't know if you saw that, Rich, but it is really interesting.
Yeah.
Yeah. That was it for me, that's my comment, and again, thank you, everybody.
so I have some comments.
Yeah.
So bear with me, being the new guy, and not being an accountant at all, not even good at it. So I'm used to seeing things in P&Ls, multiple P&Ls. I know that there's some restructuring trying to be done here, with hydro and what have you. So I would expect that hydro, treated, raw, recreation are all different P&Ls. I mean, we can argue which buckets and how many. I do see some pretty good data at the end of this presentation on raw water sales, treated water sales. But what I don't, it's nicely split up, but what I don't see is the liabilities. So like pensions and stuff, like, are we undertaking an effort to say these pensions are hydro pensions so that we can really get down to what the expenses of running hydro?
Yeah, if you go to, so for example, on page 12 of the document, page 30 of the PDF.
The real 12, or I have two.
12 of the, little 12, big
Okay,
30.
little 12. That's it. I appreciate it.
It does show, and it goes through, all liabilities by business type activity. Yeah.
I missed it.
Yeah, the, presentation of the financials is a standardized presentation that is based off of categories of activity types, so whether it's governmental activity or business type activity or enterprise. So it is presented in a manner that we don't have a lot of control over, but the data is there. But we are, as we move into rates and as we are gearing up to do our presentation on hydropower financials, we'll parse it out in manners which are a little bit more straightforward so you can understand. And understand the interconnection between how we utilize the money. So if you look to deferred inflows of resources,
Yeah.
you'll see where the OPEB is, and also the non-current liabilities, net pension liability and net OPEB liability. So as you pay down a liability, it reduces that liability on the financials. So, and we'll, when we go through the financials, we'll do kind of a cursory review of the balance sheet for you so that you kind of understand when we start throwing these words around with liabilities and asset values and fund balance, what we're talking about and how those numbers are shifted as payments, as payment liabilities are reduced, payments are made, or liabilities are increased because of a new valuation report. So we'll go through all of that because some are cash items and some are non-cash items. They're all important. It'd just be, I think, good for oversight if we had that conversation to understand it.
So is the intent on the water side, so I appreciate this, this is actually part of what I was looking for. Is the intent to always have raw and treated as one bucket?
So there is, water is it's the entire water enterprise because there is a portion of treated water that includes raw water.
Yes.
So the treated water costs are layered on top of it. If the district wanted to, you could unroll the fund more and have more sub-funds, but from an audit purpose, they will still all roll up into the mothership, which is the water fund.
Yeah, what I'm getting at is when we get to rate study is understanding what revenue is available from hydro to offset the raw water costs. And if we don't have them in buckets, I don't know how we get.
Well, we will parse out the buckets for you. From a government perspective, all money is held in one giant bucket. And then within that bucket, there are funds which identify how much of the bucket goes to which fund. And then we can further parse it out from a revenue basis and an expenditure basis based off of that particular.
Okay. Yeah, if we could have, like, at the level of pensions, these are raw water pensions, these are.
Yeah, it's not.
And maybe it's percentages.
It is percentages.
That's okay.
Yeah, and that's how we develop the rates. So when we develop the raw water rate, you know, for example, Chip, he oversees both raw and treated water, so we'll split Chip up by a percentage.
Okay, fair.
Be reduced to only a percentage. Which will equal 100.
Couldn't it, yeah, exactly, it'd be like 150%?
So Jennifer, what's the timing for the hydro overview that you referenced?
Probably, we don't have a meeting, I think I put it on the schedule already. We don't have a meeting in August, so probably the first meeting in August is canceled because of the fair. We would probably looking to do it the meeting in August. I'm trying to interlay all of this with the budget at the same time. But I think it's a good conversation for the budget and then also for the, bargaining. Yeah.
Yes.
So I think scheduled in the near term. And then OPEB and UAL, I was originally hoping to do that in August as well. But they're doing a brand new update on the evaluation right now, so I don't wanna present old information to have brand new information the next month. Now, I'm gonna punt that out to September, October timeframe, and we'll really talk about what our long-term obligations are and start establishing some strategies for pay down going into the future. Although, just keep in mind, it is always a moving target, because valuations change based off the market, based off the newest death charge, you know, there's all kinds of things, age, your census of your employees. So this fall, we're gonna have some really busy meetings, and I might ask to schedule a couple of extra ones outside of the budget.
What's the intended timing on the rate study? Are you trying to get it done before the end of the year?
It's not gonna get done before the end of the year, because there's nothing that upsets, ratepayers more than issuing a Prop 218 notice between Thanksgiving and Christmas. That would just make everybody mad. I mean, strategically it might be a good idea, but it really upsets people. So we're probably looking first quarter, to go to hearing and do the process. They probably wouldn't go into effect till, sometime in the spring.
In the middle of the raw water season? You can enact it in the middle?
We can enact it whenever we want. So when we adopt the adoption, do we do it by resolution?
Yes.
Some agencies do it by ordinance, which kind of delays things another 30 days. We can put whatever dates we want.
But if folks buy their water early to get the 5% discount, and you enact something in the middle of the rate season, are you going back from that day to the October 15th to charge them a supplemental fee?
We just have to determine how.
I mean, is that possible?
That's a board call.
It's,
You can.
It sounds like it'd be difficult to do that.
Not politically.
Yeah, well.
Well, it's just, the 5% discount, which we're gonna have to talk about, that's, it's a rough one, because it's not actually a 5% reduction in cost to us. But it's only $5,000 that is the discount, total discount equals, so.
For the whole district?
We only budgeted $5,000 for it.
But it varies a bit year to year, and it has been as high as up to 8 to 10, but recently, right?
Yeah.
That's
Some of
because,
us really love it.
like Lake of the Pines and so on, they're not taking that discount.
I don't know,
It's just individuals.
No, only raw water.
only raw water gets the discount.
So it's just individuals, though, not companies.
But the
Correct.
ranchers and farmers, I mean.
Yeah, well, you can see them in the list right now.
Yeah.
It should probably be Rancher A and Rancher B instead of their names.
And we need to,
Okay.
that's not.
I'm just trying to figure out if I can tell the constituents that there's not gonna be a rate hike in '23.
I don't know that I would,
You wanna, that's pretty long limb.
I wouldn't do that.
in 23?
Well, '23, 23, you just told me we're not gonna have a rate study done.
In 23, you're fine saying, in 24, I wouldn't say that.
Still up in the air.
And that's the budget, so the sooner we can get it done, the better.
Yeah, but
We haven't had a rate increase.
as the guy who doesn't understand this, I'm in no rush to get to a rate increase without doing our due diligence.
Right.
And I have no confidence that I understand how much the offset really should be.
We will walk you through all,
Amazing.
when we're done, you will be you might not like it.
The question that I'm gonna want answered is, what have we looked at or are actively looking at to offset the reduction in hydro, contribution to the raw water, prices?
To increase the revenue?
If hydro's doing this, and I can see that it is, but it's pretty flat, the revenue, since 17, the revenue is, and the expenses are going up, so that it's doing this. What are we actively doing?
And we'll have that discussion. We have, things we're always doing. Then, this is a tough conversation to have, because Kirk relicensing adds a whole lot more conditions.
Yep.
But with that said, I also, and we're a little out of line
I
here.
have a comment, but I'm not gonna do it because we'll.
Yeah, I'll just finish with this one thought. Just remember also that even if hydropower goes away, it doesn't mean that all of the associated expenditures with hydropower go away, because hydropower pays for the entire upper division, which still exists, even if they're not there, and that's about 50% of hydro's budget. But I don't wanna get too out there in the hydropower revenue world, but it's definitely gonna be a topic real soon.
Okay.
So, I got a question for Susan. So you have a net position statement, but there's no book value put to the district
That's asset value.
It's the asset value.
as, or no, market value.
That's the asset value.
It is.
Yeah.
Seems low.
Well, so assets, they are booked, the value is booked, based off of the value at the time. But you also have to understand, when you book the value, you also have to depreciate it. So it's a double-edged sword. You don't want to overstate your asset value, because as you depreciate based off of value divided by life cycle years, you're just going to continuously, it impacts your fund balance.
Right.
I can see depreciating a pickup or a fleet or something like that, but some of our assets are appreciating in value.
You have to depreciate like those
No matter
assets.
what.
You don't have a choice. That was a accounting modification. When was that made, Susan? I don't even know. The depreciation of assets?
Oh. And, well, that's, you have to depreciate. I mean, that's just GAAP. It's proper accounting is depreciating your assets. The only thing you don't depreciate is land, construction in progress, those type of things you would not depreciate. Like land has an indefinite life. Most everything else has a life. Construction in progress, you would, once you complete that construction in progress, you place that asset into service, then you start depreciating it. So while you're still building or constructing something, you don't depreciate it. And I think yours has your license is in there, I believe. Correct, Jennifer?
Yeah, so the FERC relicensing is also included as a construction in progress right now, even though it's been the longest non-construction project ever. Because it's a significant dollar amount that goes into renegotiating licenses, and a hydropower project that has a license has a much higher value than a project that can't operate because it doesn't. So it will add asset value to the hydropower fund once it's complete and received. And that's kind of what that finding came from, is remember when we, the one finding we had this year, which will go away next year because it's a one-time issue, we previously had all the centennial properties, including all the project work in construction in progress.
Right.
And you can't carry construction in progress on hold forever. And so the auditors had been after us even prior to MUD, to book that. Right. To do something with it. So we had to end up booking the expenditures, which took a huge hit to the fund balance. And at the same time, they should have booked the assets of those properties, asset value of the properties, asset structures on them, to the fund balance, which would have offset that. And it's put in the system, and it was literally like a box wasn't checked in the system to actually book the asset value. So that's what that last fund finding is.
I have a question. Puzzling now that I'm seeing it. So this is the 10 largest water customers sheet. Okay.
I would suggest we move on.
No, I know we're doing it, but no, it just says. I know, but it just says. I thought we only gave them raw. That's my question.
I don't know, Chip.
What was the question again?
The Grass Valley showing on treated. We shouldn't have been talking.
They do both.
They do
have
both?
a lot of community water meters at their facilities throughout. And then, we have an intertie with them that has a drinking water meter that they treatment plant, they use our water.
Oh.
Okay. I'm just curious, because I always think, oh, no, we only give them raw water.
We do say that all the time,
Yeah, we do say that all the time.
including me, myself, because I always forget. I'm the worst offender. I'm going to not be the worst offender about talking on this table.
Yes, we're not gonna talk about it anymore.
See?
Well done.
All right, is there any more questions for Susan? So a huge shout out again to the accounting team. I'm really proud of them.
So any, members of the public like to comment on our questions about the audit? None, we will.
Is that a question for me? I couldn't hear. I'm sorry.
No, no more questions. Thank you, Susan.
Okay.
Your team did such a great job.
Okay, perfect. Thank you. Bye.
What?
So board, your customary practice is to have a motion to receive and file and to authorize the general manager to publish the.
I move to receive the funds.
I'll second.
All right, Division 1,
Yes.
Division 2,
Yes.
Division 4,
Yes.
Division 5,
Yes.
Division 3. Right, general manager.
Can we have a party now?
We're bringing out the sparkling cider.
Cupcakes and whatever.
I don't have a whole lot to report. I was gonna have, just recently, the Sierra Nevada Conservancy that we are fortunate to receive a lot of grant funds from, they developed an event out at Scotts Flat for them to show off the good work their monies have done through their grant programs. I was gonna have Greg talk about it a little bit. It wasn't technically our event, so I'll let Greg, I wasn't there either.
Sure. So on the 20th, there was probably 13 individuals from the state legislature, so staff members of legislative bodies and individuals down in Sacramento came up, and Sierra Nevada Conservancy staff were here, including their executive officer. And so we gave a tour. We started out at the Bear River at the Taylor Crossing area where the river fire occurred, and went over just the considerations and the problems with fire in our region and the work that NID did immediately, the emergency actions that we took care of probably within that first couple months. Spent about, I think, $500,000 or just roughly short of that. We talked about fire suppression efforts that the state put together. They roughly spent, in total, it was about, I think, somewhere in the neighborhood of $30,000 an acre to fight that fire for the community, and put it out and move on to other fires in the region. So we had a really nice opportunity to talk down there at the burn scar. And then we got in the cars and came up to Scotts Flat, where we then spoke about the benefits of doing project work and fuel reduction work in the forest before it has burned, and the cost to do that work then, which roughly is on average, we've spent about $2,500 an acre for that work. So it really transposed for those staffers in the state capitol to bring back to their leaders and their electeds to talk about the benefits of on-the-ground cost and fuels mitigation efforts prior to massive categorical wildfires. So it was great. It was really quick. They arrived, at the river fire around 8:30 in the morning, and we finished at Scotts Flat around 11:30 or 12. So we had gone out on a little pontoon boat with them, and I think they were excited and happy. So it was nice. Yeah. Kudos to NESA and Cameron and our watershed folks for putting that together. It was a huge, generally effort to pull it together, and we had a great opportunity. The folks in Rec, Ken, Kofer, and Susan for putting together some materials and brochures for them. So looking forward to a follow-up with those legislatures, and hopefully, to continue to invite them to come back, and the Sierra Nevada Conservancy, which is a state agency. So thanks to them for putting the whole thing together and having that idea to bring these groups or these folks to the area. They proceeded in the afternoon to, I think it was Nevada City that received a grant from the SNC as well. So they proceeded, they proceeded to that project after us. Great. We had a nice time.
I would love for whenever that opportunity comes about, that we talk about irrigated pasture being fire abatement. Because right now it's not recognized by the insurance companies as a fire abatement utility. It's a beneficial use, no problem, but we're my fire insurance was canceled. So, anytime we get in front of elected, I think this would go to a broader conversation of making sure that, the board is aware of these opportunities so that we can, lay out things like this that are important to our constituents.
Yeah, and we had that request, that, you know, that this one in particular was not an NID. I mean,
Yeah.
they asked us, and I specifically asked the staff at SNC, hey, can we invite board members or so? And it was, they wanted to keep it at staff level discussion. So, yeah, it just was sort of under the radar. We didn't really talk too much about it. I understand we did supply a press release, some Facebook posts, you know, appreciating it. But, yeah, it was pretty much on a lower level.
Yeah, we can just pair fuel reduction and irrigated pasture.
Yeah.
Ranches and farms have been known to stop wildland fire.
You know, CAL FIRE has a quarterly wildfire task force that they put together. They were actually here at the fairgrounds, I think it was last fall, and came, and so many legislative constituents and folks from the governor's office in California, CAL FIRE, et cetera, give presentations, and those would be an interesting opportunity to talk about that value.
Yeah, they're pushing.
Yeah, right, because from a state level, that's where you want that.
Yeah. That was a good, meeting.
Yeah, it was great. They were very thankful and appreciative, and we'll be following up with them, and hopefully we have more one-on-one and in-depth conversations. We can head down to the Capitol and meet with them in their offices, and that would be an opportunity to really shake hands and focus on key specific issues for our region.
Great work. And then, Dustin was going to provide a quick water rate legislation update. There's been a lot of movement on a lot of bills.
Yeah, so I have pretty positive news. You'll recall that a number of bills were introduced that would have pretty fundamentally changed the water right priority system that we know and rely on. And our, associations, Aqua, Regional Water Authority, and others really did a fantastic job in building a coalition in opposition to these fundamental changes. I think that there's a recognition that tweaks can be made to the water right system to improve it, but the type of fundamental change that was being proposed was really detrimental to wide swaths of California. So I'll provide updates on 3 bills here: AB 460 by Assemblymember Bauer-Cahan, and AB 1337 by Assemblymember Wicks. Those 2 bills were held in suspense in Senate Natural Resources Committee. That means that they effectively become 2-year bills. So they could be revisited next year, and they may, but at least for purposes of this legislative session, they will not be taken up and considered further. The 3rd bill, SB 389 by Senator Allen. This is an important one, and I'll try to explain specifically for NID, but the coalition was able to obtain very significant amendments to this bill to the point where they went neutral to a wash position, which is very positive. So the bill has no further opposition from the likes of Aqua or Regional Water Authority, and so on. And the reason I think that's important for NID is because Senator Allen is also carrying a bond bill, and now that the budget's done and some of these water right bills have, at least for this year, been put on suspense, there's now a shift in focus in the legislature to a climate resilience bond, and a good portion of that, at least thinking is a good portion of this climate resilience bond, will include a water component. And obviously NID has a number of very large infrastructure needs in the relatively near future. And Senator Allen is thought to be a very important, he's one of the authors of the bond bills and an important voice in this discussion that we're going to have. So it's nice to not have to oppose an author that's going to carry something that is potentially important to you, and that's exactly where we've landed. So I, along with others, are going to participate in working groups on these bond discussions, and I'll work with staff, keep them informed as to, making sure there are funding categories that cover NID's infrastructure needs in particular. I'm thinking Scotts Flat.
Yeah. And we already put a little pin in Aqua's, brains about Scotts Flat for the bond.
Yeah.
Good news.
What's the essence of that third bill? What is it cover?
So, originally, it covered topics like forfeiture, water right forfeiture, and it was frankly scary. Forfeiture law has developed, primarily in case law, to where there has to be a host of factors. It's not just not using your water right for a period of 5 years. There's other elements. And this would have stripped that case law and basically said, if you don't use all or some portion of a water right for 5 years, you forfeit it. Well, in NID, I mean, we never use through conservation or, hydrologic conditions, whatever the case may be, we will rarely use the full face amount of, all 50-plus water rights in NID. So there was concern that there would be this, race to the spigot type thing where all of a sudden our conservation efforts would go by the wayside because we're concerned about potentially not using a right for 5 years and forfeiting it. So as originally drafted, it was pretty significant and negative. So that it was basically gut and amended to today, it would authorize the water board to have broader investigatory authorities, which in my mind is largely a restatement of authorities the water board already has, but maybe it's clarifying, maybe it's a slight expansion. So for example, if the water board wanted to investigate whether a claimant had a pre-14 right, they could initiate an investigation and, have the water right holder produce whatever information they have on that water right. I don't think it's a big deal because the water board has already done this. And for entities like NID, we have pretty robust files of, chain of title when we acquired those rights. Then, for 100-plus years now, in many cases of our statements of diversion of use where we've utilized those rights. So it could result in additional expense to NID if we receive one of these investigations from the State Water Board, but it's not something we should be scared of or nervous about because we have the supporting documentation. So so it's to a point where it's neutral. Some folks would like to see some minor changes, and that's fine, but I think for Aqua and Regional Water Authority and the larger associations, it's a fine bill. So
the state is compiling a data of all water rights held by everybody. Can we get in there and make sure that they have the right data?
So the water board already has that.
Yeah.
It's called EREMS.
Right.
What they're doing is modernizing it.
Yeah.
And I can't speak to the details, but I think it's basically deconstructing that database and building it back up so it's more user-friendly.
I have a comment.
I know someone's doing that. Find out exactly what they're doing.
That's okay. So I was asked to apply to be on the advisory committee for this, what I believe we're talking about the same thing. It's called UPWARD, which stands for Updating Water Rights Data of California. And so I sent in I'm interested, because I really think that NID should have a seat at that table. And they're going through their process. So, all I did was say, NID needs a seat at the table, I'm willing to do this, and thought that if I get positive results, then I can bring this to you, we can bring it to the board, we can talk about how best we interface with that. But I felt really strongly that I was asked to put my name in, so I did. And we'll see how it goes. But I've got a lot of documentation on it, Rich, and I'm happy to send it to you so that you have a better understanding. But I think it's important that we have a seat at that table, for sure, because there's a lot of large or corporate users who are also trying to get themselves on that advisory committee. So I think, you know, as you say, we have these robust water rights, and we don't want somebody suggesting that they should be diminished in some way. So, you know, I just felt like we needed to have a seat there. And this was just like in the last week.
Yeah, I would encourage that. I mean, I think my personal opinion is the water rights system is workable, but there are certainly areas that can be improved. And I think data management, presentation of water rights, you know, public transparency of water rights, those are all areas, and I think that upward initiative is all kind of focused more on that. But the wholesale change, the effort that some,
yes,
and I don't know what other, you know, stakeholder groups or interest groups are trying to, if they're trying to also get into that group, but.
I think so. That was my understanding. And I know Yuba, Willie over there, is also been asked to put in there. So we want to really, those of us who have these amazing water rights and have all, I think of it as all the water. I know we don't have all the water, but I think of it that way. Is that we really have a vested interest in making certain that we're there, and it's not just others from other areas. So, and if I'm the right person, I don't know. It could be staff, could be, you know, it's like, I don't know. I just wanted to get a placeholder. So.
Anything else, Jennifer?
All we have.
Okay. Chris, would you like to start our update?
Okay, I don't have any update, but I do have a comment about yesterday's meeting and what I learned yesterday, and I think it's pretty exciting. What's exciting for me, in March, Rich shared an article about, in the California Farm Bureau publication about agricultural water use, and all of our lives we've heard that agriculture uses 80% of the water. And yesterday, we heard the 1.4 million acre feet that fall on our land, and we capture and sell 130,000 or whatever it is. I bore out the fact that really, the number's almost exactly the same that they published here, that total environmental water is 80% of what falls out of the sky. 30% of that 80% is environmental water that's captured and then released. So I'm on a mission to reverse the curse on agriculture is taking all the water. I think this, it's real, thank you, Jennifer, for Plan for Water and that data coming out from that. And I'm looking forward to more data as we go on. But I thought that was really, that was a watershed moment for me personally, because this has been ongoing forever. And I think that the public, the community needs to know exactly where our water, how much water there is and where it all goes, and that hasn't been reported for decades. That's all.
Nothing. I did point you guys to an article that the California Farm Bureau and the last Ag Alert addresses the 3 farm bills. So it's their opinion.
Yeah. Rich?
A lot going on. I'll just double down on what Chris said.
Well, I attended, as did Rich, the NID or the community forum at Sierra College that our general manager led and did a superb job, and it appeared in the newspaper today, as all know, because I passed it around. That was really cool. And then, and then I told you about this water rights thing that I'm kind of dipping my toe in to see if we can't get a seat at the table. And then lastly, you know, Chris, I saw that same graph, and I've scratched my head because I too have heard, you know, ag does whatever it is, 80%, 20%, whatever those percentages were. So that sent me on a digging mission, and I'm not going to go over it right here, but I'm going to share with you the data because the Farm Bureau interpreted that data in an interesting way, and there is other data out there.
I'm sure there is.
But I'm just saying that is not the be all and end all, and it is not. I'll share the data that I have with you. So we'll just stop there. Remember, I sent it to you too. I said, is this true?
Yeah, just keep in mind, it's always really difficult when you're comparing those types of data sets because you don't know how each group is actually characterizing
That's right.
what.
That's
You know,
right.
a lot of groups use different definitions for the term environmental.
Right.
You know, how their allocation actually is. So I wouldn't get too into who's saying what.
Well,
You'd have to
and-
go through and verify everything.
Yeah, and I don't think it's necessary to like broadcast that because there are so many differing opinions based in science that are out there. That isn't the final word, I guess I could just say. I was curious. That's it for me.
Okay, and I've just been working on some customer issues, and I thank Greg and Chip for their help with those things. And with that, we are gonna, ask if we have any public comment for items to be considered in closed session.
So subject to Greg or Jennifer correcting me, but I do not anticipate any action coming out of closed session.
No.
Okay, and with that, we will close the open session. And we will have a 5-minute stretch.